Something is absolutely destroying the S&P this year, and it is
China.
So if you take a look at the S&P 500, you can notice that it's up 4.2% year to date. But when you look at the Hang Seng Index, it's actually up 17.45% year to date. And just for some context, today is 18th of January. That's 1 month and 18 days. And a lot of those days weren't even trading days because of the public holidays and things like that, right? And you can see that it's absolutely staggering that the Hang Seng Index is up 17.5%. And what if I told you, even after the 17.5% rally, the Hang Seng Index only trades at about 12 times earnings. So this is 10.2 times. It's not really correct because the date that it was updated was in October last year, which was somewhere here. Yeah, somewhere here. So you can see that it's up 13 to 15%. So let's call it about below 13 times earnings. So 12 or 13 times earnings. The objectives for this video is actually quite simple, right? It's to help you have a high-level understanding of the China macro environment, to help understand the opportunity as well as risk, and identify opportunities that can help you make money. So before we start with the slideshow, I'd like to basically give a shout out to this video, right? If you have 40 minutes, this is one of the best videos that can help you summarize China understanding, right? Because this is actually a very, very insightful video, and most of the slides that I've presented today is from this video actually. But I have been studying China for about the past 3 years already, and Alibaba stock is actually one of my biggest holdings, and my cost price is about $72, so I'm up about 76%, right? Almost a double on my Alibaba shares at this point. So I'm gonna go into the presentation and then we'll talk a bit more. Right? So we can see that the Western narrative on China has actually been very, very negative, right? So it pains me to say Hong Kong is over, Xi's model is failing, the China model is dead, right? So you can see that the Western media has been very, very negative on China, right? And very positive on, of course, the US. But we have to take a look, right? Because actually, if you take a look at the past few years in Hong Kong and in China, the performance has been abysmal, right? So is this just the stock market informing the narrative of the media, right? Because obviously we don't have to look, but the S&P has been doing extremely, extremely well, right? If you take a look here. So maybe it's because the S&P is doing well, so the articles are positive, right? It's very hard for writers or journalists to come out and say, oh, it's going to crash because everyone will hate you, no one will read your articles, right? So if we take a look at US GDP versus global profits, you can see that the US is about 25% of the global GDP, but it represents about 66% of the MSCI World Index, right? So this seems a bit weird, right, to say the least. And if you take a look at China and Hong Kong, it's actually at 2.9%, but China is 18.16% of global profits, right? So I think this is a bit of an anomaly as well, right? And next, when we take a look at China yields versus US yields, you can see that this is the greatest divergence we've ever had, right? Normally, China and US yields move about side by side, and US yields have always been lower, right? Because people have thought that the US government is risk-free, while the Chinese government has a bit more risk, right? But you can see that for the first time since this chart is only since 2013, so I can't say for sure. But I think for the first time in history, it's that the US actually has higher interest rates, long-term interest rates than China. So this is perhaps signaling that the world is willing to have smaller risk premiums in China than in the US, right? Maybe they believe inflation in the US will be higher, or maybe confidence that the debt deficit has been too big, or whatever it is maybe causing a crisis in confidence, right? So one thing that I also want to say about this is also another thing might be perhaps because Chinese savings rate are very high, so they are willing to accept a very low risk premium, right? Because if it's sitting in the bank, it's doing nothing as well, right? And I think not so many US or Westerners will be buying Chinese bonds, right? Because you could be seen as supporting the Chinese economy, and that's a big no-no in the US right now. So next, if we took a look at the biggest macro anomaly in 2024, the China's trade surplus actually rose 50%, right? And this is because I think domestic consumption is very weak right now. Consumers are very weak right now. But you can see that if their trade surplus is rising 50%, right? This means that they won't be so reliant on other trading partners, right? And because they're not running a deficit. If you're running a deficit, you're taking in more than you're exporting, right? So the next, if we take a look at collapsing economy, they won't deliver actually the best 2024 equity returns, right? And this is in a currency which is not hyperinflating. So if you put Argentina here, I'm sure they would have performed very well, right? But then their currency is depreciating at the same level. But big caveat to this is that actually if this is done using a 50-50 bond and stock portfolio, right? And if you take a look just now, bonds have been dropping a lot, right? So the pricing on the 10-year bonds should be moving up, right? So, but if you take a look at 3 and 5 years, obviously you can manipulate the data, pick out the best ETFs, and you can have this kind of presentations, right? And it's done by this guy that is quite long China. So I would say that slightly biased information, because if you take a look at the more popular ETFs, it's not exactly showing you the same illustration as these two beautiful pictures here, right? But nevertheless, you cannot deny that China this year has been performing at a very, very good clip, right? So 16.85%, just now it was 17 point something percent. But that kind of numbers in just about 2 months is very, very impressive, to say the least. So another thing that you wouldn't expect in a collapsing economy is obviously innovation and moving towards the future, right? You see that China unveils new futuristic fighter jets. Don't look up, but China AI is catching up. So after this was released, obviously DeepSeek was released, right? You can see that this article was in the 24th of December 2024. So China beats Starlink. China unveils a prototype for the fastest high-speed trail in the world, right? And then proposes battery and critical mineral tax, right? So I'm not sure whether my face is blocking, because actually I can't see my face on the screen, but hopefully I'm not blocking too much. So the next slide is explaining why domestic consumption probably did not implode as badly as Western media has led us to believe, right? So you can see that the domestic vehicle sales and registration is actually at an all-time high, right? And you wouldn't expect this from an economy that is completely out of it, right? Let's say there's going to be economic Armageddon, you wouldn't see all-time high vehicle sales, right? So next, I think I should exit this and move it a bit, because I think I'm blocking it. So you can see that, understand the China property bust, you have to go back to 2018, and banks have dramatically cut back on real estate lending. So this is what the leftovers of the 3 red line policy looks like, right? It's actually absolutely destroyed the real estate market, right? Because after the 3 red lines policy, banks have basically been led to borrow more to the industrial sector and less to the real estate sector, right? Because obviously the real estate sector is not a productive asset, right? And especially the way that the Chinese invest in real estate, they are willing to leave it empty. And you can see this in not only China, but places like Vancouver, Canada, maybe New York, in the US, obviously, and all these places where a lot of Chinese capital has come. They have bought the building and they don't even live in it. They just use it to park money and use it to take out loans and things like that, right? So next we take a look at China's industry, right? So this is auto exports, right? And you can see that China since 2020 has actually become the leader in auto exports, right? And you can see a lot of these countries such as Germany and also the US have been slapping tariffs left and right on China because they are afraid that they cannot compete, right? So let's take a look next at the power plants, solar capacity, and also cars. And you can see that a lot of these positive developments from China is coming out, right? And you can see that this is actually very, very impressive. China installs the most robots in the industrial world, right? But obviously this was in 2022. So the next thing, again, I think I have to move this a bit. The anomaly of the massive Chinese trade surplus, right? So how things usually work is country runs a large trade surplus, capital inflows to the country, stronger FX. This obviously has been a bit distorted from the Chinese government, right? Because they manipulate their currency a bit, right? And then there's strong domestic consumption, and then there's trade surpluses, right? But you can see that this strong domestic consumption is actually non-existent in China, right? Because confidence is so low in China. So something that begs the question, right? How can they be exporting so much yet confidence is so low, right? So what seems to be happening in China is that they're running big surpluses. China businesses are earning US dollars, and then their entrepreneurs lack the confidence to reinvest in domestic stocks or property. And you can take a look at even stocks versus property, right? Stocks in China is like a very small amount of their wealth versus in the US, right? In the US, about 50 to 55% of households have money invested in stocks. And I believe in the Chinese market is, I think, single digit or low double digits, right? So the things that come out of this is the money stays at the bank, which is why the Chinese government bond yields are keep falling to new lows, right? Or they buy gold, and that's why gold in the bull market. So these are possible explanations, right? They're not certainties, but they are good theses, right? So another thing is they keep US dollars offshore, and they use the US dollars to buy US tech, right? Which also explains why the US market is moving up, right? But I think this one I find not so feasible because the US market is moving up because a lot of these pension funds keep piling money into the market, right? Doesn't matter what the valuations are, just keep piling money into the market. So the main themes I see playing out in China is this, right? Government stimulus, record low interest rates, low valuations, trade surplus, high savings rate. It's $789 billion in savings in 2023, right? And you can see that China versus US, there's a big divergence, right? I'm not saying anything bad about the US, but they have a very consumer-based economy where currently their savings rate is about 2 point something percent of their income, right? Where it used to be like 14-15%, right? And then another thing is super investors coming back. We'll discuss more of this in the future, right? So business icons meeting with governments once again. Actually, Jack Ma just met with Xi Jinping yesterday, according to some reports. And then headwinds in China, right? These are the risks, right? So basically, you can see that these are the opportunities and also these are the risks, right? So record low consumer confidence. There's no denying that. They might have the money, but if people don't spend the money, it's still just money sitting in the bank, right? Lack of transparency when it comes to numbers. So you can see that China has been manipulating a lot of their data, right? There's no denying that. I might be a China bull, but at the same time, we have to see things as they are, right? Sometimes when the numbers are not good, they just restrict the numbers from leaving the country, or they restrict reporting of the numbers, right? So there's no denying of that, right? So there's capital outflows. Basically, these are the US people earning US dollars and or maybe even earning yuan, right? And then they move the capital offshore and then they buy US assets or European assets. So this is why they have capital controls in China as well, right? So the property crisis is obviously a very real thing. This has contributed to record low consumer confidence. And the last is the VIE structure, right? So the VIE structure is something else that I consider quite a big risk. Obviously, there's a low chance of this materializing, but at the same time, we can't say that it's not a risk, right? So how do we benefit? This is my personal plan, so don't copy exactly. I'm just telling you what I'm doing and some things that I'm looking into, right? So personally, I'm buying and I don't think there's need to take huge risks for huge returns in this case, right? I'm buying some multi-stock. This is something I'm not in yet, but I'm looking to buy. But I'm not in a huge rush to accumulate multi-stock, right? Because it's not one of the fast-moving big tech companies that will have huge rallies within this time, right? I see this more as a slow and steady beneficiary of the China macro trend, right? Basically, if China does well, multi will do well. And if China doesn't do well, multi won't do well, right? So something that I'm buying right now is actually JD.com, which is trading at 6 to 10 times its 2025 earnings, excluding the cash, right? Obviously, 6 to 10 times is a very, very big range, right? But even if we end up at the tail end of the 10 times, we won't be losing that much money, right? Or we won't be losing money, we just make money at a slower rate. So its cash is about 40% of its market cap. The next is obviously Alibaba, right? This is a good opportunity if you're not in the shares already. But I'm already in the shares. I'm already up 75% and it's already grown to a big position. So psychologically, I wouldn't be able to add to this position, right? Unless you don't have a position at all, then maybe it's easier, right? Because again, it's still trading at 12 to 13 times free cash flow. And I think both of these companies definitely deserve to trade upwards of like 25 to 30 times free cash flow if and only if the growth comes back, right? So that is another theme that I'm thinking that all these main themes will generate, right? That government stimulus and these record low interest rates will lead back to consumer confidence. And these companies historically have grown at 70, 40, 50%, right? So now it's flat growth or 5% growth in the case of JD.com, and people have left them for dead, right? So what happens if the growth actually comes back and it trades at 25 times earnings and 2025 earnings are higher than expected, right? You can do the math, right? For me, JD.com in one of my cases can be a 5x, right? So the last one for me is actually Tiger. This is a speculative bet, right? This is because all the US brokerage have done incredibly well after earnings, right? Because you can see that the US is obviously in a bull market right now, right? But if we take a look at Hong Kong, let's say if Hong Kong is just entering a bull market, or China is just entering a bull market starting maybe September 2024, don't you think that they will have like the same effects as maybe all these Coin, Robinhood, and interactive brokers? So I'm expecting the same results when Hong Kong rebounds, right? And Hong Kong is definitely rebounding right now, right? And another thing that I put under consideration is China big tech firms as well as the other stock brokerages, right? So how I intend to play this is a lot of money will flow first into the big tech companies, JD.com and Alibaba, and then I'll have a smaller position in this. And as these things run out, I will trim the position and put some into this, right? But you have to be very careful with this because you have to exit at the right time, right? This is definitely not an evergreen investment, right? And none of these brokerage stocks are, right? Because in bull markets, their earnings look like they can grow forever, and investors project their earnings to grow just straight up. But actually what happens is it's actually a cyclical, right? Because when there's a bear market and the stocks are not trading so well, obviously the earnings for these companies will honestly get destroyed, right? But we're looking at tremendous upside, I would think, if this follows the same pattern as the US counterparts, right? So another thing that I have taken a look at, but it's not under my consideration, is capital heavy companies and real estate companies, and also banks, right? Banks because I don't know enough, capital heavy companies because just in general, capital heavy companies are not very desirable in my opinion, and real estate companies because I don't understand the balance sheets well enough, as well as I don't like the fact that in Malaysia also they do the same thing. Basically they pre-sale the property before they build it, right? And the way I've seen them do it even in Malaysia has not been very beneficial to the people that are buying it, and you can only do that for so long, right, before the consumers realize, why the hell am I buying these properties when, you know, every time I'm getting screwed, right? So the last part of this video, I'm gonna leave you with a prediction, right? My prediction is the next bubble, right, is going to be in the Chinese stocks, right? Because the setup is all there, right? So if you take a look at the US markets in 2008, right, they were marked by the same things, right? Three of the main themes is very low valuations, very low interest rates, and also fiscal support from the US government, right? And you can see the same thing in 2020 also, right? After the sharp decline in March. So before I end the video, I wanted to let you guys know that I'll be doing individual videos and deep dives for these companies, right? So if you're going to enjoy that, obviously hit the subscribe button and also hit the bell button. These are like high level in-depth videos such as this video itself, right? So that's about all I wanted to share today. If you did enjoy the video, do help me smash up the like button, hit subscribe, and also hit the bell button. With that being said, have a fantastic day ahead and peace out.